When banks give credit, it's not just about loans. It includes advances, guarantees, and even off-balance sheet commitments. And every credit facility carries risk. So banks follow a clear lending policy. First, they set lending limits for officers and define who can approve how much. They carefully choose the types of loans, industries, and customers they want to serve. Before giving any loan, proper credit appraisal is done to check repayment capacity. Interest rates are priced based on risk, cost, and expected profit. And loan maturity is planned to match the borrower's cash flows. But even good loans can become risky if they are concentrated in one area. So banks diversify. They spread lending across different industries, sectors, and geographic regions. This way, if one sector faces problems, the entire portfolio is not affected. After lending, monitoring becomes critical. Banks regularly review financial statements, track repayments, and watch for early warning signs. Any deviation from policy is reported to management quickly. Early detection helps prevent bigger losses. Banks also set exposure limits. They restrict how much can be lent to a single borrower, group, or sector. These limits are linked to the bank's capital and deposits. Collateral is taken as security, and its value is checked regularly to ensure protection. Sometimes loans still go bad. These are called impaired or problem loans. In such cases, banks may renegotiate terms, restructure payments, or increase security. If recovery seems difficult, the account is transferred to special recovery teams. To stay safe, banks also conduct periodic portfolio reviews. They don't just look at a few accounts, they review a large portion of total loan value. Special attention is given to large exposures, related party loans, overdue accounts, and doubtful loans. At the individual loan level, banks check how funds are used, whether collateral is sufficient, and whether the borrower can still repay from cash flows. If business performance weakens, risk ratings are adjusted accordingly. Finally, banks create loan loss provisions. This means setting aside money in advance to absorb future losses. They analyze current risks, past loss trends, and portfolio quality to decide how much provision is needed. This acts like a financial cushion during bad times. So overall, credit risk reduction is about being careful at every step. Before lending, during lending, and after lending.